Let's get the action going. We have Ron Wiener, RDM financial strategist. He says stocks are still the best game in town. And Larry Shover in the pits of the CME. Larry, congratulations to the Blackhawks. Every CME trader who's been on Fox Business today wants to just say that right off the top. So congratulations. They win the Stanley Cup. And the markets win today, at least for the Bulls.
Yeah, that's right. But recall the good old days when Europe was the lightning rod for the market. We're absorbing all of our energy and focus. Right now, we have this multipolar narrative going on where it's much more than Europe. No one seems even to be worried about Europe. It's about China. It's about Fed and tapering, emerging market capital flow. We have rising yields. People are worried and not used to all these moving parts in the market. So it's really nice to see this knee-jerk reaction that we saw today, a little bit lowering in asset class volatility across the board. But we are faced with a lot of moving pieces that we have not seen in a long while.
Well, and Larry, one of those moving pieces, of course, are interest rates. A 10-year bond yield up again. The bond markets are getting decapitalized. What are the long-term effects of that?
Well, the long-term effects might not be that good. Because keep in mind, the stock market rallied on stunning profits. Against the profits was low wage compensation and low interest rates. We know that the Fed just killed the yield curve, so making money very cheap for them. If rates continue to go higher, that's going to be very difficult for profits to replicate themselves as they have for the past 3 or 4 earnings cycles.
Except that we've got Ron Wiener here of RDM, and he's made some great stock picks in the past on this network, and he still feels, Larry, and Ron, let's bring you in, that stocks are still the best thing going right now. That's an obvious comment, at least from your perspective, because you're a bull, but you're also, totally out of gold, and you feel that you should reduce exposure to emerging markets. What within stocks keeps you so excited at this point?
Well, first off, there are entry points in a lot of stocks that we think are attractive, but beyond that, the U.S. economy is doing better. We know people are doing better. People are feeling better. I think that if you look at earnings are solid. They're not great, but they're solid. But what are you going to do? Go into bonds? I don't think so. In fact, we think bonds are the bigger bubble. I've been saying this for, 9 months, that bonds are a bubble. Bonds are a problem because the investor who invests in bonds are typically in bond funds. They're going to take losses. I mean, there's going to be real blood on the streets. If you own individual bonds, we're in the triple B space ourselves, we're making 4.5%. That's a safe place. But when bond investors get their statements at the end of this month, they're going to be shocked. And these are the skittish investors. These aren't equity investors. They're bond investors. So I think that alone is going to let people say to their broker, what am I doing? I thought I was safe in bonds. And the broker's going to have to say, well, you're in bond funds. You're not in bonds.
Well, let's talk about equities, because there are some entry points for certain equities here. And if you're looking for a deal, American Tower seems to offer one. First of all, they give a dividend of about 4% right now. But this is a stock that has not traveled up to stratospheric heights. It's come down recently, and you think it's an entry point. Why?
Well, I think it got mispriced. It became a REIT just recently, and REITs got sold off terribly, and I think this went down with all the rest of the REITs, and it shouldn't.
By the way, let's explain what they do. They own the cell towers, and they also rent them out, right?
Right. They own about 55,000 cell towers in 16 different countries. They have an emerging markets expansion plan, which we like very much. But more importantly, they just became a REIT, got whacked because they became a REIT, we think. But they have tremendous cash flow. They have a 13% compounded revenue growth since 2007. So they're very solid. They have a relatively conservative balance sheet. But more importantly, they're in the 3G to 4G market. They have contracts that guarantee them a 3.5% gain each year, or increase in fees from Verizon, AT&T, Vodafone, all these big companies. They're a growth story, and they just got sold off. So this is a good time to get in, I think.
American Tower, and as you continue to hunt like a wild boar for truffles, you liked Starbucks the last time you were here. Do you still feel that Starbucks, which I think since you mentioned it back in March on the 25th, up about 11%, where's the opportunity here? They just announced some price hikes once again.
Yeah, it was a 1% price hike on about a third of their products. Starbucks has got a plan to open 3,000 more stores by 2015. They're an emerging markets play. They bought a tea company, a bakery. They're now in the K-Cup business. great management. It's not a cheap stock. It's trading about 24 times, but it's got over a 20% expected rate of return, rate of growth. I think it's going to be fine, but it's an emerging market story, not just a good executing management story.
And Ron, pipelines were in the news today. The president kind of punting once again on the whole issue of the pipeline, the Keystone Pipeline. But there is one pipeline company, Kinder Morgan, which you like right now. Why?
We've owned it for a long, long time, and it's been spectacular. This year, again, we think what happened was they had a pipeline plan to go to California from the Midwest, and nobody wanted to buy into it. I think it got sold off there. That's nuts. This company is executing. Their cash flow is up $200 million to over $1 billion a year. We think they're doing.
By the way, they also have invested in coal, and some people say, well, boy, you don't want to do that.
They're the biggest pipeline company in the country, and they have 70,000 miles. They're executing 6.8% dividend and currently tax-free. And their dividends have increased every single year. So it's a growing dividend story. It's a tax-advantaged dividend story, and it's oil. It's oil and gas. It's not going away.
Larry, as we finish up, at least for now, from the CME, the big question becomes, do we continue, for example, to just see that the credit crunch that we saw coming out of China, is it really just a one-day story? I mean, the market really came back today.
No, I don't think it's a one-day story at all. We need to look beyond China and just realize that, since 2000, 2001, there's been an amazing correlation between China and the rest of the emerging markets. So with that said, capital flight out of the emerging markets, especially with the risk of rates going higher here in the United States, that could be a significant problem for us. I mean, China does have a lot of levers that they can pull, a lot of things that they can do. However, it's not a one-day deal, and it's not just China. We need to look at all the BRICS nations right now.
Good advice. Ron Weiner and Larry Shover.
Thanks, Larry.
Again, we'll see you in a few minutes from the S&P futures pit as the S&P futures close. So we know that the bulls were definitely on the run today, but what happens tomorrow? For that, we turn to the S&P futures as they close, and Larry Shover in the pits of the CME.
Well, I think we're going to see a lot of the same, a lot of small, tight, volatile ranges. I mean, all eyes are on this earnings season that doesn't come until July the 8th. I'm very excited about it. It could be a game changer. Let's face facts. I mean, the market has rallied and rallied and rallied on strong profits and low interest rates. Now, offsetting that, now we have higher rates and profits might be leaking a little bit. So what happens? Will that be a game changer? And let's keep in mind, we're up about 11% on the year. Maybe we don't need to be greedy and say maybe 8 to 10% on the year is really okay, given 2.5% GDP growth in the United States.
Yeah, already nice gains there. Thank you, Larry Shover. By the way, Larry, any idea as to whether interest rates are going to continue? We almost saw the 2.6 again today. Are we going up that far again tomorrow?
We definitely could. Just keep watching the data. Right now, it's all data dependent. No, a little bit of clarity, but no methadone for the bond market right now.
Good to see you, Larry. Thank you very much.